Wall Street had a wake-up call this week. The engine driving so much of this market, AI, is starting to show some cracks. Oracle and some other big names may have come too far, too fast. And the question is whether this is just profit-taking or the start of something bigger. At the same time, the geopolitical chessboard is shifting. Donald Trump has reversed course on Ukraine, signaling stronger support. And if that sticks, it could reshape the defense trade, ripple through the energy complex, and even redraw the map for European markets. And finally, there's Disney. The House of Mouse is being forced to confront its three-letter problem, ABC. Analysts are whispering the unthinkable, not selling, not spinning, but shutting it down. And believe it or not, the math might actually make sense. AI pullbacks, geopolitical pivots, and a media giant staring down its future. It's all happening at once, and it all matters for your money. Welcome to The Money Runner. I'm David Nelson. Let's start with the House of Mouse. This one is close to my heart because it was one of the few times in my career when I actually got in close to the bottom. I reasoned earlier in the year that despite all the problems Disney was facing, the worst was priced in, even a recession. Also, believe it or not, in what seems like a lifetime ago, I got to be a Disney employee a couple of times a year when I toured with the Turtles. We'd often play Orlando, Disney World at Orlando. A couple of times a year, we'd get employee badges, and that would give us access to an entire city underground that most tourists never get close to seeing. Most people don't understand that underneath Disney World, there's a city. There's highways, cafeterias, recording studios, movie studios. It's all there. A huge technology complex, and you don't get to see it. And the best part of those badges, it gets you to the front of the line for the best rides. All right, back to Disney stock. Earlier in the week, fans were obsessed with Jimmy Kimmel being taken off the air, and then his eventual return. Wall Street was looking at it through a different lens. Needham analyst Laura Martin floated the nuclear option. Don't sell, don't spin, just walk away. So do the math. First, the damage on paper, it's not catastrophic. Disney would take probably a one-time write-off of about 10 to 11 billion, roughly 5% of its market cap. I think Wall Street would treat it as a discontinued operation, a hit today but forgotten tomorrow. Second, stripping out ABC's declining ad revenue would make Disney's growth profile look a lot cleaner. Without the drag, revenue growth could accelerate by 40 to 60 basis points a year. In plain English, faster growth, higher multiple, potentially maybe $20 billion in added shareholder value. Third, by ditching broadcast licenses, Disney sidesteps federal oversight. No FCC, no public service obligations, no political headaches. In a Gen AI world where delays are costly, that's the real edge. So finally, the Disney story has always been about reinvention. Parks, studios, streaming, those are the engines. ABC looks a lot more like an anchor. Whether Bob Iger has the stomach to actually cut the cord is another matter. But make no mistake, this conversation is happening, and it goes right to the heart of how investors should value Disney going forward. Sometimes the hardest part of investing isn't spotting the winners. It's knowing when a legacy turns into a liability. And for Disney, ABC may be crossing that line. Earlier this week, President Trump stunned both allies and adversaries with a sharp pivot on Ukraine. After months of hinting that Kyiv might have to cede territory for peace, he now says Ukraine can take all of its land back from Russia. His words came right after meeting President Zelensky at the United Nations, and they hit like a thunderclap in the middle of already tense negotiations. Trump called Russia's war effort aimless, saying a real military power would have had this wrapped up in a week. Instead, 3.5 years later, Moscow looks like, in his words, a paper tiger. That's a big swipe at Putin, and it dramatically shifts the tone of U.S. policy. For investors, this is more than just geopolitics. Markets hate uncertainty, and Trump's sudden reversal raises new questions. Is Washington prepared to double down on military and financial support? Can Europe and NATO shoulder the burden Trump is pointing to? And if Ukraine really pushes to reclaim every inch of lost ground, what does that mean for energy markets and defense stocks? If Trump follows through, then investors will have to rethink positioning, up their exposure to defense names. Some of the obvious ones are out there: LHX, Lockheed, Northrop Grumman, even General Dynamics. And I don't have much exposure right now, so I'm going to have to rethink it too. If Trump is going to push the energy card and get Europe, Turkey, and India to reduce their dependency on Russian energy, you're going to have to look there too. Companies like Cheniere, LNG, Schlumberger, SLB, both deserve a weighting in your portfolio. Now, I just talked about SLB on Fox Business with anchor Charles Payne. SLB is now a digital oil play, and its partnership with NVIDIA makes it an AI play as well.
SLB?
SLB, everybody looks at this as a legacy oil service company, and it is. But this is a technology play. They've partnered with NVIDIA. Their digital services unit will almost double in size. It's 11% of the revenue right now, will be 25%, and that AI goes to increasing well production. So I think it's going to.
So maybe AI picks up where the fracking miracle is starting to fade off.
It'll be, but it's going to be natural gas, and natural gas is going to be a major component of any kind of AI build out. Yes, even oil stocks can go AI. Like most things in life, the devil is in the details, and we'll all have to watch and see if Trump follows through or if this is just a negotiation to get Putin to the table. Most investors understand that powerful secular growth themes are rocket fuel for bull markets. 2 years ago marked the beginning of what may be the biggest investment theme in my career, AI. However, investment themes go through stages, and the final stage never ends pretty. Situational awareness and where we are in the cycle are paramount in navigating the trade successfully. Now, I talked about Oracle last week and the fact that despite a very good quarter, they are free cash flow negative and likely to be that way for the next couple of years. Not the end of the world, but when does that end? At a recent Belpointe investor conference, we had investor favorite legendary hedge fund manager Dan Niles as a guest speaker. Now, Dan pointed out a lot of things in the Oracle quarter that gave him pause. Now, Oracle is guiding their Oracle Cloud OCI business to achieve 70% annualized growth. Now, that sounds awesome, but forecasting out 5 years in an industry this young is difficult at best. Dan mentioned another CEO, John Chambers, CEO of Cisco during the dot-com years, who made a similar statement. After achieving 55% revenue growth in 2000, they guided to 30% growth for the next several years. And in 2002, they actually went revenue negative with a 15% drop in sales. Look, AI is the most important investment theme likely in our lifetime, and wonderful advances in science, medicine, and the industrial complex will make our lives richer. But not every company is going to succeed. In fact, many companies will likely fail. Markets are never static. They shift, evolve, and sometimes break. For investors, that means living with the uncomfortable truth that no strategy, no thesis, no trade is carved in stone. What we talk about here isn't the 10 Commandments. It's a battle plan. And battle plans are only as good as your willingness to revise them when the ground beneath you changes. Adapting isn't weakness, it's survival. And in markets, just like in life, survival is the first step towards winning. All right, that's it for this week. Don't forget, if you want to learn more about yours truly, David Nelson, or the Money Runner, go to my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is the Money Runner.